All right. And today we have the privilege of hearing from two representatives from Everence Federal Credit Union. So we have Bryant Keel, he is the Community Development Officer, and Kevin Gill is a Financial Wellness Manager. So they're here basically to help you prepare for navigating the financial choices and responsibilities that you're going to face when you begin your career. And we know that these can be scary topics, and they're often things that we are pretty undereducated about before we have to face them. So we're excited to get to learn from the insights that Bryant and Kevin have, both from their professional and personal experiences. So with that, I will go ahead and turn it over to you all to get us started.
Thank you. Thank you. So I'll share my screen here. We have a PowerPoint slide prepared for you all today. Hopefully I can get to that. Give me 1 second. You guys see my screen here?
Yeah, you're good.
Yes.
It's in presentation mode though.
Hopefully this doesn't take too much longer. Do you see my screen? Awesome. Am I in presentation mode or no? Okay, nice. All right. Yeah, thank you guys for joining in, and hello. We were talking before we started here about this type of presentation and when Kevin and I was in college, and how this is something that I wish I would have heard, but I probably heard it, wish I would have listened to, but for some reason did not. We're going to show and teach you really how to avoid financial pitfalls personally and in the marketplace, and in some regard, how to become financially well and how to become a millionaire, because I'm sure we're all on that journey. So definitely want to get into the nuts and bolts of that. But before we do have a quick icebreaker that I would like to share with you all. So this is going to be, I'm going to share a few statements, and if you believe that the statement I share, it's going to be about 7 or 8 statements, is true, I would like for you to give me a thumbs up. You can do it with your finger like that, or with your mouse and scroll over to the reaction button and give me a thumbs up that way. The first statement is Bryant Keel is an African American. Give me a thumbs up if you believe that statement is true, and then everybody's like, yeah, I just wanted to see if you guys were with me here. All right, awesome. The second statement is, so I am an African American. I'll just put that out there. Yes, that is true. The second statement is, all debt is bad. Give me a thumbs up if you think that is true, or a thumbs down if you think it's false. All debt is bad. Now, I won't define bad, but I'll leave that to you to define. I don't see no thumbs. Are you guys thinking? We have 7 more.
I don't think there's a thumbs down icon.
Oh, there's no. All right, so you can. Yeah, that's probably why. Yeah. So if you think it's false, just give me the double hands up. I think that's an icon on it, right, Kevin? You don't.
I'm not sure. Let me see. I haven't used
All right,
it.
so the hand clap. The hand clap.
I was gonna say, yeah.
Yeah,
you got clapped.
Awesome. Okay. All right. Yeah. All right. Great. The third one is credit cards should be avoided at all costs. Thumbs up if you think it is true. Clap if you think it's false. Awesome. Yes, that one is false. Renting a house, the next one is renting a house or an apartment can be more cost effective than buying a home. Thumbs up if you think it's true, double clap if you think it's false. Renting a house, apartment can be more cost effective than buying a home. And that one is true. Taking a pay cut should never be considered. is the next one. Taking a pay cut should never be considered. Awesome. A few more here. Budgeting without a steady stream of income is a waste of time. And that one is false. And then the next one, you should begin your retirement fund when you have a steady job. True with the thumbs up. And clap if you think it is false. And that one is false. All right, and we're going to get into the whys during the presentation. If we, for some reason, skip and don't answer, there'll definitely be time at the end for you to ask questions pertaining to those pitfalls or myths or truths and false. But definitely want you guys to chime in during the presentation if you have questions as well. Definitely don't have to wait until the end to ask your questions. All right. I was reading through, before we get into the nuts and bolts of our presentation, I was reading through the Business Insider article the other day, and some of the statistics I found in that article were quite intriguing. It was talking about, college students and where they're at financially and between the ages of 18 and 21. And in the article, I found that at least on average, college students are in $3,000 credit card debt, $15,000 student loan debt, and don't currently have a budget in place. Although we hope that is not you guys, but Kevin and I will be sharing a little bit from a banking and financial perspective about how to avoid the pitfalls, but as well as avoiding the pitfalls if you are in those buckets, how to get out of it. All right. So moving along here, just a little background on Everence. We were founded to provide mutual aid to people, really mostly Mennonites with financial needs following the economic difficulties of 1930, really after World War II. I don't know if you guys know much about Mennonites, but Mennonites are pacifists, so they don't believe in war. But directly after, well, they did serve in servitude roles during World War II. And after the war, they were in great need of, financial aid in multiple different avenues like housing and insurance and things of that nature. So Everence was really created to help Mennonites, primarily white in rural and suburban areas, to get ahead in life. But over the years, they've added many more mutual aid and stewardship programs, really responding and adapting to the needs of the communities that they were in during that time. However, fast forward to 2010, Everence really has been over the years rebranding who they are, realizing that they're no longer just kind of the white Mennonites that they were in the 40s and 50s, and really wanting to reach out to the bigger C church, and also realizing that the country is browning more and more. And, if they stay within that bubble, that they will in some ways miss out on a larger Mennonite base, but also community base as it relates to the rest of the world. So they changed their name. It used to be Mennonite Mutual Aid to Everence in 2010, and really had a vision of wanting to see Shalom come in not just suburban and rural areas, but also in urban areas as well. So this is our team in Philadelphia. Leonard Dow, as you see here, is leading the charge here in Philly and in our urban markets. And then we have Randy Nice, myself, I am the loan officer. Kevin here, who is the branch manager, and Natalie Martinez, who is in charge of working with our churches, nonprofits, and small businesses in the Philly area. Now I'll switch it over to Kevin, and he's going to share with you guys how to become a millionaire.
That's a lot of pressure. Yeah, so again, we're just going to go a little bit more into why we're here, why we exist, and I promise we'll get to the steak and potatoes in about a slide or two. But just a quick reference of what our mission is. Why do we do this? What is our mission? The main reason Everence exists in the first place is to help people incorporate their faith and values into their financial lives and to follow the biblical instruction to be good stewards of our resources. And the way that we kind of visualize that, that Everence uses a lot is the vine. And that's what this image is here, is that the vine graphic on the screen shows a simplified version of how this can happen. The process consists of 4 areas. The first one is discover and plan for God's purpose. So there's the spiritual aspect and just the spiritual wellness of it. Living responsibly, that's the more practical, day-to-day interactions, what you can do to better your situation, both physically, mentally, and financially. Preparing for the future is obviously the biggest portion when it comes to retirement, or it comes to entering the workforce or anything of that nature. And then ultimately the last goal is to be so well off or be as comfortable as possible that you can give back generously. So that's kind of our 4 areas of attack. And luckily for you guys, you're still in the early stages of life. So it's pretty easy for you to start square 1 and 2 to eventually get to 4. So we'll go to the next slide here. And just to give kind of like a context of what we do, like Brian said, I'm the branch manager at the credit union, but I'm also a certified financial wellness counselor. And what that means is that I sit down with individuals, talk about budget, talk about credit building, or any other situation, whether it be retirement or anything like that, and what to plan for, what should be the form of attack. And we do that through these types of services that we offer, which is your typical, depository services, personal or business checking accounts, money markets, certificates. We also do student loans, mortgages, home equity, auto loans, as well as the business loans. And at this point now, we'll start to dig in on the next slide on some of the more practical stuff that you guys probably came here for. Budget being the first topic of interest, but before doing that, I'm going to give you guys some background about my story, and you can see how and why this stuff works. I'm currently 27 years old. I graduated from Temple University back in 2016. And as soon as I graduated, I was like deer in headlights when I saw that, student loan bill come in, and it's like, hey, sink or swim, get a job, pay this off, or, live with your parents and figure out what you can do next. And for me, having not learned about it in school, having, parents who did their best, but weren't really financially literate, I went ahead and started researching on my own and trying to figure out, what is it that people who are successful and that get themselves out of this situation do. And with lots of research and planning, I was able to use budgeting and debt consolidation, not from a loan perspective, but from saving and paying off. I was able to pay off my student loans maybe 2 years after coming out of college, which it was a bachelor's degree. So it was 4 years, $30,000 of student loans, which is actually not bad in comparison to students nowadays and what they're having to get stuck with out of college. But then a year and some change later, was able to purchase my first home and also get married. So that shows you the power of being able to do a lot of things with something as simple as budgeting and planning ahead. It's realistic for you to be able to get rid of, student loans if you have a plan in place. It's a little easier for some more than others. Some might be able to live in their parents or get a roommate and minimize expenses to pay it off earlier. And some of us might have to, go out on our own and have to spend a little bit more, but it all goes to show the power of applying these things. So when it comes to creating a budget, you want to choose what you can do without. That's the biggest step when it comes to budget planning. We all know that if you spend $2 a day on coffee, that can pile up to be a significant amount of money per year, right? And some people might justify coffee. They'll say, hey, I survive off of this. If I don't drink my coffee, I'm not useful. So if you'd like to justify it that much, then think of some other things that maybe you're spending a little bit more than you need to on, and saying, hey, I'm going to focus on what I need. And then once I figure out what it is that I need and I've taken care of my expenses, then we can talk about wants. But the first things first, you want to choose what you can do without and start to minimize that as much as possible. Consider additions to make. So that's another aspect of trying to generate more income. If you're working a part-time job, maybe starting something on the side. When it snows outside, maybe shovel a little bit. Or if you're, very good with social media, maybe doing some marketing for somebody and saying, hey, just pay me this much per post and I'll take care of there's many opportunities nowadays to try to supplement your income and make things a little bit easier. Third point, establishing an emergency fund. I cannot stress this one enough. Since I bought my house, something has broken once a month and it's been super expensive. And this is something that people don't tell, not even my parents really prepared me for. Once I moved in, plumbing burst and it was thousands of dollars to fix. And then the roof collapsed and that was another few $1,000s to fix. So I know this is down the line for a lot of you, but getting in the habit of having an emergency fund is going to help you in the future. Because I had money put away, 3 to 6 months of expenses, it didn't hurt me when these things happened. And I kind of just said, oh, okay, well, I have money allocated for that, take care of it and move on. But for you guys, when you're starting to get into the workforce or starting to move into your career path, having it in place, especially if you're still in the early stages of your career, and maybe it's a temporary job or something that is more cyclical rather than annual, having that in place will keep you afloat if you have expenses. And then
just to come in really quick, Kevin, I want to add to that. Even with inspections, sometimes people think inspections will, prepare you for whatever issues you may have. That's not always the case. Like Kevin, you probably had inspections and things of that nature when you purchased your house, but still things happen, right? Like the plumbing issue. And like you said, thousands of dollars. I mean, it can cost a lot of money. I just want to stress that it's really expensive. So yeah.
That's it might seem off topic, but it's something that people just don't talk about often enough. So and then once you get to that point, right, so you want to take care of yourself, right? You want to have enough money put away. You want to supplement your income. You want to make sure that you eliminate your expenses as much as possible. Then comes the fun part, is accelerating debt payment. So if you have student loans, for instance, and you make a certain amount of income and you're able to allocate a good amount of it to the side, even after your emergency fund is fully funded and you've supplemented your income and you've eliminated lots of expenses, what you get to do now is you really get to throw as much money as you can at your debt. And it's going to hurt in the beginning because you're going to feel like, hey, I can't eat ramen noodles, cup soup every day. I want to, splurge every once in a while. But when you pay off your student loans and you're debt free in 2, 3, however long years it takes, it changes the game for you, because now you're no longer held back by bills that, you feel are going to linger around for years. Your average American keeps their student loans up until retirement, or they even die with it. So if you can get those eliminated, or a good chunk of them eliminated early, you're already ahead of the curve. So that's definitely a crucial part. Once you start to put everything in place and start to crunch the numbers and start attacking your debt, that's going to set you up to then later invest, which is the next step after all your debts are paid for. So we'll go to the next slide. And it's called Start Saving. So obviously we touched on emergency funds and putting funds aside, but there's also little tricks that you can do if you're not very good with money. If you feel like if you have it on hand, you're going to spend it, you can start to trick yourself by doing little things like having direct deposit set up for bills that you need to pay, or even set up a direct deposit for a savings account, right? So if you're not good at saving, Maybe you tell your employer, I'd like a portion of my check to go into my regular account, but I'd like another portion, 20, whatever percentage, to go into a savings account that I just won't touch. So you can do that. You can also allocate it through some applications. There's a lot of financial applications out there now that help you with these things. So it's a lot easier than before, when everybody had to use envelopes and label it. Hey, this is my car envelope and this is my sofa envelope that I want. And, having to go under the mattress and pull it out later. Our generation is better because we have these digital assets that allow us to do it a little bit more effectively. Put pay increase into savings. This is a big one mentally and psychologically speaking. When we get to make more money, we tend to spend more of it. And it's unnecessary sometimes. Obviously, there are times where it makes sense because maybe you're collecting more debt, right? If we get a pay increase and now you're like, well, maybe now I can afford a house, so therefore I'm going to spend more. But if you can help it, figure out what your cost of living is. Say, hey, my bare necessities and my survival depends on this much amount of money. And if I were to get a promotion or get a raise, I'm going to pretend that I'm still only making the money that I was making prior to that. And then what I can do then is take that excess and put it to the side or throw it towards debt. But obviously, when you get to this point in terms of saving and investing, you'd like to already have your debt kind of taken care of. But keep that in mind when you enter the workforce and you start to move up the ranks, or if you're entering and not really having long-term income and then become a full annual salaried employee, keep that into consideration. Hey, I was able to survive off of half of what I make now. I'm going to pretend that I'm still only making that much and then saving the rest. In terms of vacation, obviously, you don't want to get so caught up in the numbers that you don't live life. It's important that mentally you treat yourself every once in a while. So in terms of vacations and emergency accounts, you want to create those accounts if you need to. Again, this is a way to trick yourself. If you have a vacation account, a regular account, and your saving account, you can even say once a month, I'm going to put $50 into my vacation account. And that way, when it's time to book the ticket or do whatever you need to do, whatever you have in there is what you're going to spend. And that way you assure that you don't spend more than you need to. Same thing with the emergency accounts. And you want to use your emergency accounts instead of credit cards or any other, revolving debt for unexpected expenses. And again, it's planning ahead. Having an emergency savings, it restricts you from having to overspend on things that you couldn't afford to pay for normally. A lot of times people's cars break down or something happens, they put it on the credit card, and guess what? Now you have your student loans and you have this bill. It's putting you further into the hole. So that's the importance, again, of the emergency savings. And in this instance, if you have family that has more than one income, or if you're with a roommate and you guys agree to kind of help each other out, maybe one person pays the expenses and then the other person is in charge of saving or in charge of helping pay down certain debts. And then maybe later on in life, if you get with your spouse, or if you, again, continue to live long-term with a roommate or something like that, using that is a very strong partnership, and it helps your money kind of go further away. And then to this last point, this is where I'm going to spend a little bit more time. So when Bryant says, if you follow these steps, you'll become a millionaire, it sounds funny and he's exaggerating a little bit, but it's actually, there's some truth to that. In terms of retirement, if you're in your 18 to 20-year-old phase of life, realistically speaking, if you put a good amount or just a certain amount of money away annually, you can retire a millionaire. And that's not exaggerated. In the stock market and investment, whether it's a 401k or anything of that nature, the annual return is usually maybe 10%, 12%. So if a 20-year-old, for instance, invests, and this is a big number, but just to give you some context, if a 20-year-old invests 10,000 today into, the stock market, and it grows at 12% annually, and the next 50 years, you'd make $2.8 million for retirement. And that will most likely carry you, into your passing, and maybe even being able to leave something behind for the next generation. as opposed to starting when you're, 50 years old to start putting into your retirement at 12%, you only retire with 96,000. So that just shows you the difference of time and having time on your side. The earlier you start, the more well off you'll end up being. So obviously, as soon as you can get your debt taken care of, attacking retirement or asking your employer about the retirement vehicles they offer is going to be essential. There's typically two different types of retirement vehicles. You have your traditional 401k, which means that they take any contributions out of your pay pre-tax, which means that, before you get your paycheck, they take it out and then they let it grow. And as you contribute and it grows, you pay taxes later in life when you retire. But the other vehicle, which is usually the best option for people under 30 years old, is a Roth IRA account. And even older than that, but the power of it is even greater when you're 20, 30, 18 years old, because you put your money in there after you pay taxes, which means that after 20, 30 years, when you retire and you take it out, you pay zero taxes on that. You only pay taxes on maybe the growth, not what you contributed. So, if you retire with $2.8 million in 50 years, if you have to pay taxes on that and you're in a higher tax bracket, then you're only going to get, 1.7 or something like that, as opposed to if you had a Roth IRA and it grows to 1.9, you get 1.7 out of the 1.9. So I know it's really technical and it sounds crazy. It took me a while to kind of get a grip on that, but it's important that you understand maybe just the basics of it and go do the research, because it's very powerful to understand once you're, interviewing for jobs and maybe already in a job, but you hadn't started contributing into retirement accounts, to say, hey, what are your accounts? What do you offer? Do you guys contribute? The employer matches the contributions to your retirement. That is super powerful, and you want to take advantage of that, because if they put, $5 for every $10 you put in there, you've already made 50% return on your money, technically, before it even starts to grow. So at that point, you look at it as free money. For every $100 I put in there, they're putting 50. That's just going to accelerate your opportunity. So those are the things you want to look for, you want to ask for, and to give context, it can make a huge difference to the point where you are literally retiring a millionaire if things go well and you're staying consistent. That's the biggest point, is just continually to put into it. If the market crashes and you take everything out of it, you're actually hurting yourself. It's better to stay in it, keep contributing, pretend nothing happens, because history has shown that when it crashes, it comes back up threefold. So those are the things that you want to look at in terms of budgeting, retirement, and savings, that will set you up in a great position. And you can start to really focus on your career, focus on certain things, and not so much get bogged down by, your debts or your student loan, or, hey, I'm close to retirement, I don't have much put away. I couldn't tell you the amount of times people I've talked to who are in their 50s, 60s, they're close to retirement, but they feel like they can't retire anytime soon because they are going to retire with almost no money to put aside. So those are the things you want to, again, consider. If you have questions about those, we're here for it, but continue to look into it, research it, do your own due diligence, and you should be well on your way.
So Kevin just talked about, a lot. It was really heavy stuff, I think. Definitely want to open it up for any questions you guys have. I won't spend too much time here, but just wanted to pause for at least a little bit and breathe, because I feel like that was a lot of information at one time. And then if you guys have questions, then definitely answer your questions. You can also ask your question. You can also put them in the chat box if you like as well. And then we can answer them that way. All right, so moving along. So Kevin talked about healthy spending habits. He went into the investment piece. He also talked about getting out of debt and his strategies for that. So now I'm going to talk a little bit about, going into debt, right? like how does that even make sense, right? So I'm going to share a little bit about how do you do it from a healthy standpoint. As the loan officer, it is my job to not only, get you a loan, but help you get a sustainable loan, one that you can afford to pay back. Because I don't want to be chasing you for the money you owe us, right? And repo and cars and things of that nature. So I want you to get into a debt that you can afford. And taking out debt should never, ever be a casual conversation. Or a casual decision. It's one that you should ask yourself about its impact first, right? Like these questions here are great questions to ask yourself before going into debt. Will this debt limit other options for me? What's the final cost with interest, right? Interest is expensive when you think about the amortization schedule, right? That 4%, that 10% could be attractive initially, but as it amortizes over the life of the loan, it adds up. So $100,000 mortgage, for instance, at 4% over the life of the loan can end up costing you double that $100,000. So in interest alone, you end up paying an additional $100,000. So at the end of the loan, you're paying $200,000 instead of $100,000. So those are things you want to research prior to getting into that loan. Other questions: does this fit into my long-term goal, or does this purchase keep me living well below my means? And sometimes, you may think you can afford to get into a loan, and then something happens, and once you get in it, your life, you still have to pay that loan back, right? And it just changes your lifestyle. You can no longer do the things you want to do, whether it be a home, a car, so on and so forth. So yeah, those are some questions you want to ask and to ponder before getting into the loan. Another big piece is understanding your credit score. So a credit score is one you should know even now, right? You should know where your score is. If someone were to ask you, I hope you don't answer the question, but you should have a good idea of where you stand with your credit. It's a 3-digit number that is computed through something called the Fair Isaac Corporation. They have this algorithm for computing your score, and it ranges from 300 to about 850. 300 means that you're not doing so well with your credit, and 850 means that you're doing stellar. You have an amazing credit score. And this is the thing that is determines kind of if you will qualify for a loan, and if so, what rate you will get. And there's 3 really popular credit reporting agencies. There's TransUnion, Equifax, and Experian. We use Experian on our consumer loans, and then for bigger loans like mortgages or business loans, we do a tri-merge where we'll take all 3 credit scores, and then we'll use the median one for risk-based pricing, and we'll get into that in a little bit. But you really want to know. So as it relates to the understanding how they really get to your score, so this is kind of a makeup of how they really get to that stellar credit 850 credit score. So as you can see the percentages on this slide, so 35% of your credit is payment history. Now what payment history is, all the things on your credit score currently that you're paying off monthly. So it may be like an auto loan or a mortgage or a personal loan. If you're paying that on time every month, you're contributing greatly to your credit. But the moment you become 30 days, 60 days, and 90 days late, it begins to tank your credit by 35%. So this is the most important thing on your credit, making sure that you're paying it off on time every month. The second most important is the amount you owe. And this is related to your revolving debt. So let's say you have a credit card with us for $1,000 with Everence. You have another one with Bank of America for $1,000, and you are not utilizing any of that credit. So you have 100% of the credit allotted to you, available to you. that means that you're in great standing right now. However, if you were using 100% of that $2,000 allotted to you, then that will tank your credit by 30%. And if you were using $1,000 of that 2,000, that's around 50%, right, of your credit allotted to you. Then you know, it will affect your credit by, in some regard, half of that 30%, so 15%. So you want to just make sure you're staying below 10% threshold for your credit to look pretty good. However, we recommend that you're making sure that you don't borrow unless you can pay it off on time every month, because whatever is left over on a credit card or home equity line of credit, you'll have to pay interest on that money the following month. So you want to make sure that you're paying it off every month on time. So that's 65% of your credit, just in those two things. The other three is the length of credit history. So how long have you been in the credit card game? If you're new to credit, of course, it's going to affect you negatively, but it does, you know, help the more things you have. So as you can see on the next one, 10% is credit mix. So that's, do you have a mortgage, a car loan, a personal loan? The more you have, the more responsible it seems, and the better it is for your credit. And then the next one is new credit. So are you constantly applying for credit and taking out your credit cards and auto loans and so on and so forth? If you are, it does affect your credit negatively by 10%. So this makeup really is what determines the score you receive from the credit reporting agencies. Now there's a ton of different credit reporting agencies, but again, the three that most banks use and that are out there are the Equifax, Experian, and TransUnion. Moving on to the next slide. So why is a high credit score important? So high credit score, which I briefly touched on, is really important as it relates to risk-based pricing. So this is something that us lenders use when determining your rate. So if you were to come into, you know, my office and you had a stellar credit score of 850, you had great income for let's say $100,000 mortgage at about 5% for 30 years, and even that's pretty high for the market right now. Right now, the market is around 3.25% to 3.5% on like a 30-year mortgage. That will put your total along with interest around $193,000. So that's that extra $100,000 that I was talking about that you would have to pay over the life span of the loan. Let's say you were someone with not so great credit score. Let's say you came in around 500 credit score and you were looking for the same exact loan. That will put your interest rate at around 8%. And then at the end of the loan, you end up paying $264,000 for the exact same loan. That's about $164,000 over. So you're paying literally around $70,000 more than the person with a good credit score. Now, if you have two 30-year mortgages in your lifespan, that's a heck of a lot of money, or just a 30-year mortgage. That's a ton of money that you could have put into retirement, right? You could have become a millionaire quickly, or you could have, bought another home, an investment property, or contributed to a small business or something like that. So those are the things you really want to hone into when you're thinking about your credit. Another one is auto loans, right? So for a $25,000 auto loan at 3% for 60 months is about $27,000. So you're only paying about $3,000, $2,000 more for that same loan. With bad credit, you can be in the upwards of 15%, and that'll cost you around $35,000. So that's about $9,000 more on a 5-year auto loan. And if the average person has about 5 to 6 cars in a lifetime, right, on a loan, it can really add up quick. So that's something you want to definitely pay close attention to when you're thinking about your credit. So that really wraps up our seminar. This slide here just shows you guys how to become a member with the credit union if you're interested in membership. We do have, a branch in Philadelphia, and you can also become a member over the phone with us. We can take applications. And then we'll open it up for questions from you guys. Any questions you have, definitely you can put it in the chat, or you can ask it here over Zoom.
Yeah, and there's a question here from Taylor. Her question was, for many student loans are in deferment right now because of COVID. Would you recommend still paying on them if you can, or taking that money instead and saving it? So that is a fantastic question, because it's a very unique situation and it's unprecedented what we're going through. And typically, the rule would be take care of debt first after having an emergency fund in place. But because the situation is so rare and the government's kind of pardoning everybody from having to pay right now, if you don't have an emergency fund or an emergency savings account right now, especially, this is kind of like a gift, right? Because it's giving you the opportunity to go ahead and start an emergency fund. That's always step one. So I would say, yes, you want to put it away, start saving it, because you're not going to accrue any interest on that loan. You're not going to get penalized. There's not a late fee associated with it. So all of those reasons give you the freedom to go ahead and fund your emergency account. Given the situation that we're in, that's kind of what the government's asking you to do anyway. And that's the reason behind doing the deferment, is to say, hey, make sure you have a bird nest, make sure you have protection, because if you're working and maybe might get out of work, you'll have that put aside for when student loans maybe do kick back in. You'll have money aside to kind of get you through a few months until you get back on your feet. So I would say take advantage as much as possible, put as much away as you can. And if you exceed the 3 to 6 months of expenses put away, great, that's extra that you can then maybe put into savings or put into maybe debt repayment. You become a little bit more liberal with the expenses once you reach that 6-month mark. But right now, I would encourage everybody. I'm definitely taking that approach. Not that I have student loans anymore, but I'm taking advantage of this opportunity to maybe take the stimulus checks that we're receiving for those who are, receiving them, and putting it away and just strengthening my nest egg, because we don't know what the next few months or even year might look like. So hope that answers your question. And that was a great question.
Yeah, thank you. I guess a follow-up question would be, because I have multiple loans through like different places, when would be the best time to consolidate all of them?
Yeah, that's a good one. I think that you really want to consolidate them when the interest rate for the consolidation loan is lower than the average of all of those loans. However, it could also be easier for you if all of those loans were in one place. So that's something you really want to consider. Is it harder because all the loans are all over the place for you to really pay them back? It shouldn't be, but that is kind of one of the reasons you should. And then if not, I would just, hold off until the interest rate just jumps lower than the average of all of the other loans.
Yeah. I would also say, so I had that situation where I had multiple accounts, and I just looked at the big number. I would say look up the debt snowball technique, look that up, research it, because instead of consolidating, I just lined up the debts in order of priority. And I said, I'm going to pay all of the monthly payments on all of them, but I'm really going to attack this one with the highest interest first because it's growing exponentially. And I'm going to put all my extra funds into that one. And then once that one's done and paid off, what I would have paid monthly for it, I roll it over into the next highest one. So there are two paths. You can go ahead and consolidate, get one interest rate, pay that monthly fee, and you know what that bill is going to be every month. And it's going to grow at the same rate every month. Or if you're a little bit more organized, and you know, I like to strategize, and I like the number going down on the highest interest rate first. It just felt better. I'm a goal-oriented person, so seeing that number diminish helped me to pay the rest of the debt off faster. So it's all psychological in the sense, if mentally it makes you a better person with debt, if you see it all consolidated into one, and you know mentally, I'm going to attack this thing because it's one thing instead of 10, go for it. If you feel better saying, I'm going to attack the high interest rates on this individual one first, and I want to see it go away before I attack maybe the smaller ones, do that. But I would highly recommend everybody who's got questions about debt repayment and techniques to look up the debt snowball, because that's what I used. And it's super powerful. Once you get past that first or second, account, it starts to like it insinuates, like a snowball starts to get bigger as it goes down the hill, and then you start attacking all the smaller ones a lot faster.
The other repayment option that Kevin briefly mentioned was called the avalanche method, where you attack the highest interest loans first. And that would probably be the one that a lot of loan officers would advise you to do, just because of how quickly the interest accrues on the larger loans. However, as Kevin said, the debt snowball has been more popular these days. There's another question in chat. It says, what would be an ideal amount to have in an emergency savings? Kevin, you want to tackle that one?
Yeah, so we typically say 3 to 6 months of expenses, and that's everything, right? So whatever it costs for you to eat once a month, your rent bill, your phone bill, everything. You want to calculate what money goes in and what money goes out, and then you take that money that goes out, you calculate it monthly, and then you times that by 6, and that huge number, whatever it is, it's going to take a while to get there. You shouldn't be like tantalized by that number and saying, what, I have to put, $15,000 away. I don't have that, that's just more of a benchmark. If you get to that number, that's a really healthy number where, hey, if I'm not working, if all things go bad, I can survive for 6 months. That's going to buy you tons of time. And especially now where it's taking quite a bit of time to maybe find a replacement job or, maybe get back on your feet. But if you have zero, start with $1,000, start with something sustainable first. Maybe I'll get 1 month of emergency put aside. And then once you get that 1 month and you got a rhythm going, you're like, okay, now I need to get 3 with your eye on 6. And once you get to 6 months, you put it away. You don't have to necessarily contribute to it anymore. And now you can focus on, paying the debt off even faster. Or, hey, maybe I want to start contributing to my retirement. Or, hey, maybe I want to, use it to do whatever, start a business, whatever the case is. But 3 to 6 months is a good rule of thumb. You really want to think about it. If I were to lose my job, how long do I think it would take to replace that? And then put that many months away if you ever forget. You're welcome.
One thing I think it might be helpful to keep in mind as well is that what would typically be a time frame that folks can find another source of employment after they've lost a job is increased at this time, partially because there are a number of folks that are out of work, and additionally, the Philly area is an increasingly well-educated, well-trained area, which means increased competition. So, I would definitely, having worked with a number of alums and other individuals that are currently seeking, I'm noticing that it's a longer time. More applications are necessary than might have been necessary a year ago at this time. So I do think your thoughts about an emergency fund are really spot on. And I would push towards the higher end of the time frame than the lower end. Look, if you get a job quicker, great. But if you don't, like I'm familiar with some people right now who are looking at the 8-9 month range, and they still have not found full-time work. So it is definitely a little bit more stressful at this particular time for sure.
Yeah, no, that's a good point. I'm glad you brought it up because 9 months seems to be the consensus for me as well. People I know personally got lucky and at the 9th month, now they're employed or finally getting into the job, but it is a little bit harder. So that's good to keep in mind maybe for COVID purposes. Again, everything's different. So all the rules we've had, they're kind of fluid right now, but at least they're a guideline for you to mentally put yourself in. So yeah, if you can get to 9 months, it seems really unrealistic, but you'd be surprised how quickly time goes by and how much money you have aside. I can tell you the many times I look at my account and I'm like, when did I have this much put away? And it's kind of like an encouraging surprise, right? Because then you're like, okay, all right. And it puts you at ease. So yeah, maybe 6 to 9 months is a little bit, more realistic for this time. But when things hopefully start to settle down, the rule of thumb is, what is my projected time of unemployment or my projected time of not being able to afford my student loans or whatever, and make sure I have enough put aside to be able to pay those things. So yeah, thanks.
Any final questions from anyone? Thank you both so much for your time and your generous information for our participants today. I know that will be useful to even if it's not all retained right now, there's a familiarity with terms and concepts that wasn't there previously. It makes it easier to adjust and handle with when it does come their way. So thank you so much. And thank you the rest of you for attending. Hope you have a great evening.
Thank you guys. Thank you.
Thanks for having us.